Namaste, good evening. Session 2 is to focus on the first half of session 2 is to focus on assessment of firms, and then we will go into assessment of trust or capital gains depending upon the time available. Okay, if possible, I will also the solutions are there, but still, if possible, I'll also record the solutions in one of the days. Whatever we are not doing in the classroom, I'll give it to you. Right, friends? I'm starting the next level of revision, which we are still in PGBP. Okay, we will not go out of PGBP till we say a dot for assessment of companies. Till that time, we will be in and around PGBP in some manner. Okay, before that, let us go into assessment of firm. Okay, assessment of firm, right? Shall we take some time to quickly recollect whatever we need to understand about the firm? Okay, whatever we need to understand about a firm, we will try to consolidate it for some time. Okay, let's take the time to just understand, oh, this is firm. This is what specifically for firm I need to understand. Okay, right? So, friends, we all know a firm is a partnership entity and it includes an limited liability partnership also. It includes an LLP also. A firm is a partnership entity, and the income tax law makes it mandatory for a firm to have a return deed. The firm should have a return deed. The share of profits of the partners should be clearly mentioned in the deed, and the deed should be registered with the department. If you satisfy this condition, I will call you as a firm. Otherwise, even if you don't satisfy any of the three conditions, return deed, share of profit clear, and not registering with the IT department, if any of these things is not fulfilled, I will call you only as an association of person and not as a firm. So, a firm is something which is evidenced by a deed. Generally, we have it clearly in our examination that it is a PFAAS, partnership firm assessed as such. So this is not an arena to worry. Okay, the residential status of a firm depends upon where the control and management is. If the control and management is wholly or partly in India, then it is a resident firm. If the control and management is completely outside India, then it is a non-resident firm. Repeating, control and management wholly or partly in India, we call it as a resident firm. Control and management wholly outside India, we call it as a non-resident firm. Okay. Now, for a firm, section 10 subsection 2, if I go chapter wise, okay, first I covered residential status chapter. Then with regard to exemption, for a partner, though it is not for a firm and partner are interrelated in study also. We don't study partner separately, firm separately. They are interrelated. Okay, section 10 subsection 10 2 says that share of profit of a firm is exempt in the hands of the partner. Repeating, section 10 subsection 2 specifies share of profit from a firm is exempt in the hands of the partner, because the firm has paid the tax. There is no cascading effect of it. Okay, so we are over with the exemption. Salaries does not have a specific provision for firm. Partners remuneration is not salaries. We saw in PGBP. Partners remuneration is not salaries. So they have nothing to do in salaries chapter which is specific to firm. House property has nothing to do with is specific to a firm. If firm has a house property, then the mode of computation is going to be the same. Okay, but there is no specific provision which affects the firm in the case of house property. That leads us to PGBP. From PGBP, we have specific provisions available for firm. The first one is concept of proportionate depreciation. Concept of proportionate depreciation. What is this concept? Friend, normally proportionate depreciation is never a concept under income tax law. Normally, proportionate depreciation is never a concept under income tax law. Proportionate depreciation, now accountancy or company law says if you use an asset only for 3 months, into asset into percentage into 3 by 12, 4 by 12, 7 by 12, like that. But under income tax law, it is more than 180 days or less than 180 days. That is what is needed. Okay, so there is nothing called proportionate depreciation. Then what is this proportionate depreciation? It arises in the following situation, my dear friends. That is, if there is a succession, conversion of a firm into a company, amalgamation, demerger, in all these cases, if it is going to happen in the middle of the year, in these cases, in the case of succession, amalgamation, demerger, conversions, firm into company, company into LLP, whatever may be, if it is going to happen in the middle of the year, during the course of the year, two entities has to claim depreciation. Suppose if it is a conversion of a firm into a company, the firm should also claim depreciation, the company should also claim depreciation. The firm should also claim depreciation, the company should also claim depreciation. In such circumstances, the law says ignore the event, as if that amalgamation, as if that demerger, as if that conversion did not take place. Compute the depreciation. Compute the depreciation, apportion it between the two entities based upon their period of effective usage, based on their period of how they effectively use the asset. So, my dear friends, okay, proportionate depreciation can be a concept which is specific for a firm when it is converted into a company or company converted into LLP. Let's try to work out some one time that particular aspect to get some interest. So after that, 33, 34, 35, 36, 37 are all common. It has the PGBP chapter. Whoever is coming under PGBP will have it. Okay. That leads us to section 40B, interest and remuneration payable to partners. There are some things which we are going to understand here. Okay, interest and remuneration payable to partners. The law has not given a blanket permission for us. Whatever may be, you can give. Such a blanket permission is not available in our law for interest and remuneration to partners. There is a cap, there is a restriction, and the restriction is either as a percentage or on the profit. But basically, the law wants to ensure one thing. Let your deed says that you can pay interest and remuneration. Okay? If your deed itself, deed is something which you yourself prepare. If that itself does not say, I cannot give you any interest or remuneration. Interest or remuneration can be paid provided it is mentioned, authorized in the deed. Sir, while drafting the deed, I forgot. Or while drafting the deed, I had interest as a different percentage, remuneration as a different percentage. During the course of the year, I am changing the deed. The law is very clear, income tax law is very clear, where the deed is amended. The amended provision will be applicable only prospectively, not retrospectively. Sir, from 1st June 2020, partners are eligible for remuneration. From 1st June 2020, partners are eligible for interest on capital. Interest on capital can only be for 10 months. And not for the entire period of 12 months. Yeah, okay. The partnership deed may be amended in effect from 1st April. But income tax law says where the deed is amended, such amendment will be operative prospectively and you cannot have a retrospective effect to it. You cannot have a retrospective effect to it. Okay. Remember this point. This is a mere specification that remuneration will be paid as per section 40B is sufficient. இது Anil Hardwares அப்படின்னு ஒரு case, okay, where they have said that a mere specification, you need not say what remuneration is payable in the deed. Okay, you need not say what remuneration is payable in the deed as a quantum. You can just say as per 40B or up to 3 lakhs 90%, more than 3 lakhs 60%, because I don't want to have a difference between my deed and the act. Yes, a mere mention in the deed that the remuneration is payable as per section 40B fulfills the condition and you need not worry about it. Okay, now maximum remuneration payable is either as per act or as per deed, whichever is less, because act is superior. And suppose if you yourself agree to pay lesser, I'm fine with it. Okay. Interest on capital 12% per annum. Interest on capital 12% per annum is as per act. Okay. Deed can say. And remuneration payable to working capital is based on the book profit of the firm. Book profit is nothing but profit as per PGBP chapter, additions, deletions, everything put together. Profit as per PGBP chapter before providing for remuneration, but after paying interest. Okay, after computing interest, but before remuneration. Book profit means as computed under PGBP, after allowing interest on capital, but before charging any remuneration. See, book profit is divided into 3 actually, but you can understand it into 1. If there is a loss also, you can pay 1,50,000. That let us, it is inherent condition. Up to 3 lakhs of book profit, which means even in case of loss. So up to 3 lakhs of book profit, 90% of book profit or 150, whichever is higher. More than 3 lakhs, 60% of the amount exceeding 3 lakhs. 60% of the amount exceeding 3 lakhs. Remember, a loss-making firm can pay up to 1,50,000. Okay. Remember, the term remuneration will always include salary, bonus, commission or any other sum. You pay it as royalty. Sir, one partner devotes more time, so I want to pay him more. That is in your deed. As per act, all these things put together is only remuneration to the partner. And whatever remuneration paid, that has been allowed, paid or payable, which is allowed, is taxable in the hands of the partners as business or profession. The allowable remuneration and interest on capital is taxable in the hands of the partners as business or profession. So remuneration and interest is a specific section under section 40B. There is a cap on maximum either as per act or as per deed, whichever is less. If there is an amendment, it has only prospective effect. Interest is 12% per annum. Per remuneration depends upon the book profit of the end of the firm. Book profit up to 3 lakhs, even in case of a loss also, 90% of book profit, which might be negative also, or 150, whichever is higher. So that's why we interpret even a loss-making firm can pay 150. Okay. And more than 3 lakhs, okay, on the amount exceeding 3 lakhs, pay 60%. Okay, compare it with actual remuneration and the allowed remuneration and the allowed interest on capital in the hands of the firm is taxable, because one person's expenditure is another person's income. Firm's expenditure become partner's income. It is taxable in the hands of the partner under the head business or profession. Under the head business or profession. And remember, no expenses can be claimed against the remuneration. Okay, remuneration can be paid even to if a company is a partner, etc. They can also pay. Okay, remember this morning also we saw that case law, great city manufacturing company. When there is a specific section 40B, now you cannot say in that first section, in that first question of Lalita and Divya, I told you, can the assessing officer disallow the remuneration which is as per 40B? Saying, no, this is not as per fair market value. No, you cannot. No, you cannot. Okay, right? And remember, interest on loan provided. This is the important point. Interest on loan provided by the partner is not covered in 40B but covered under 40A subsection 2. Payment to relative, but the fair market value is 12%. Why? Because otherwise everybody will say that instead of paying it as capital, I will pay it as loan and get more interest. So it is not, the disallowance is not going to be under 40B, the disallowance is going to be under 40A subsection 2. But for that, the fair market value will be 12%, and that is only for partners, not to the relatives of the partner or partner in representative capacity. So 40B is one of the comprehensive provisions of firm where we say how the firm's remuneration is computed and remuneration of partner, how they are taxable, what are all the additional points. Apart from this, we don't find anywhere in PGBP exclusively for a firm a particular provision. Okay, that leads us to the capital gains chapter. Capital gains has some specific provision for partners and firm which are very interesting. Why I say that there are specific provision? Well, conversion of a company firm into a company or conversion of a company into LLP will not be regarded as transfer. That means capital gains will not come, subject to some conditions. Subject, it is not a blanket thing, subject to certain conditions. Okay, we will come to that. Okay, similarly, if partnership firm dissolves, what the provision is? If a partner transfers asset to the firm, what the provision is? So these are going to be really interesting from the capital gains perspective. Okay, let's walk into capital gains to understand. Conversion of a firm into a company will not. Yes, somebody is asking me a question.
Sir, one question. Sir, what about the partner's interest on drawing, sir? It is a business income
That
for the
is
firm.
not at all a concept in income tax law.
No, can the partner, because his...
No. Neither it is an income for the firm nor it is an expenditure for the partner.
Oh, okay.
Yeah.
Sir, and one more doubt. What if partner is acting as in the representative capacity of other persons?
There is no restriction. FMB will be as per market and not as per 40B.
Oh, okay.
So coming to capital gains chapter, my dear friends. Conversion of a firm into a company, provided the following conditions are satisfied. Conversion of a firm into a company, provided the following conditions are satisfied, it will not be regarded as transfer. It will not be regarded as transfer. What are all the conditions? Take over all assets and liability. Nama merger concept all assets and liabilities should be transferred at book value. Do not pay any partner any consideration. But one important condition which I want you to know is all the partners of the firm should become the shareholders of the company. They should together own 51% of the share capital of a company for a period of 5 years. They should together own 51% of the share capital of the company for a period of 5 years. Suppose in between they sell it off. Initially, I'll give you the exemption, thinking that you will hold it. Later, if they sell it off, whatever exemption I gave will now become taxable. Once more, okay, all assets and liabilities should be taken over at book value. All partners of the firm should become shareholders of the company. They should together own 51% of the share capital of the company. I don't mind whatever proportion they own. Why I am saying this is for the next condition. Okay, next case. But here I'm not bothered about what proportion they own. Together, the partner should own 51% of the share capital of the company. In that case, I will accept. Okay. Whereas, conversion of an unlimited company or a private limited company into an LLP, conversion of unlimited company or private limited company into LLP. How does the provision work? All the assets and liabilities of the company should become the assets and liabilities of the LLP. Okay, and it should be recorded at book value. Now for three special conditions. All the shareholders should become partner and they should hold the shares in the same proportion. And they should hold the share in the same proportion. The new profit sharing ratio of the firm should be in the same proportion in which they held the shares. Okay, all the shareholders, all the members of the company should become the partners in LLP. They should share the profits in the same proportion in which they held the shares. Okay, and that 5 years continue. The turnover of the company should not have exceeded 60 lakhs and the net asset of the company should not have exceeded 5 crores. Three special conditions here for conversion of a company into an LLP. Okay, all the members, all the shareholders should become partner. Angiyo, all the partners should become shareholder. No problem. But what is that extra condition? There I told you proportion is not mentioned. But here the profit sharing ratio of the partner should be the same proportion in which they held the shares in the company. Okay, turnover should not exceed 60 lakhs and 5 crores should be the net worth. In this, if these conditions are satisfied, it will not be regarded as transfer. Okay, let us, okay, conversion of a firm into a company, conversion of a company or a private limited company or unlisted company into a LLP. Both are not regarded as transfer. Remember that 5-year condition in both the cases. Now, after that, introduction of partner capital asset by a partner. On the date of introduction, what is the value you are recording in the books? Full value of consideration will be not the fair market value recorded in the books for the asset. You will write asset account debit to partners capital account. What is that asset account debit? Okay, that will only be regarded as the value of the asset. Okay, full value of consideration of the asset. And on dissolution of a firm, okay, where a firm is dissolved and assets are distributed to the partners, it is treated as transfer. This provision is applicable even if partner distribution takes place without dissolving the firm. At the time of retirement also, if a partner retires also, if assets are distributed, it will be regarded as transfer. For the firm, taxation will arise. How will I tax it? Okay, FMV, full value of consideration, will be fair market value on the date of distribution. Fair market value on the date of distribution. Dissolution illa, fair market value on the date of distribution. It is taxable only in the year of distribution. Capital gain arises only in the year in which it is distributed. Where the partner subsequently transfers, cost prevailing in the books will only be taken as cost of acquisition, cost to the previous owner. So it's a double taxation exercise. But from the firm's perspective, now understand once more, in the case of dissolution of firm, it is regarded as transfer. Not only dissolution, if the continuing firm, going concern, distributes asset to one of the partners, retiring, deceased partner, whatever it is, it will be considered as transfer. Fair market value on the date of retirement illa, dissolution illa, on the date of distribution will be regarded as full value of consideration. In the year of distribution only, capital gains will be computed and taxable in the hands of the firm. So once more, 4 specific provisions in PGBP 40B alone, but 4 specific provision in capital gain. Conversion of a firm into a company, conversion of an unlimited company or private limited company into a LLP, capital asset introduced as capital contribution by the partner, dissolution of the firm. These 4 are the specific provision with regard to firm in capital gains chapter, nothing else. IFOS has no specific provision. Clubbing has no specific provision. It has no specific provision with regard to partnership, but there is something very interesting coming up, which is set off of losses. Sir, can I set off a firm is converted into a company? Okay, can I set off? If a partnership firm is reconstituted, what will happen? Can I set off? That is answered in section 72, 73 and all under the set off chapter. Set off where there is a change in the constitution of the firm. Where there is a change in the constitution. How will constitution of the firm will change? Admission of new partner. No specific provision. Kadayadu. Retirement or death. Retirement of death. Where there is a change in the constitution of firm. Due to what? Due to retirement or death of a partner, such a portion of loss pertaining to that partner. Such portion of loss pertaining to that retiring or deceased partner cannot be carried forward by the firm. Cannot be carried forward by the firm. Okay, so if there are three partners, one partner retires and they are equal partner, 1/3 of the loss cannot be carried forward by the firm. Provision is only for loss and not for unabsorbed depreciation. That is still can be carried forward by the firm. Okay, and it is only due to retirement or death. It is not due to any other reason. That is change in the profit sharing ratio, admission, adukku kadayadu. And one small benefit the law gives you is, suppose if it is due to death and you are appointing the legal representative, you are taking, the firm is taking the legal representative of the partner, then continue. Where if the change is due to death of the partner and the legal representative is appointed for the same benefits, then the firm can continue to enjoy the carry forward of losses. So set off of losses, the point to remember is only if the firm is a continuing firm having the same partner, they can fully carry forward. Where the continuing firm and there is a change in the constitution due to retirement or death, share of loss of such partner cannot be carried forward. But if the legal representative is appointed, you can, this provision is only for loss, not for unabsorbed depreciation. Now, if all the conditions mentioned above, that is, in capital gains we told you, okay, conversion of a firm into a company, 5 years hold, all shareholders, all partners, shareholders, if all those conditions are satisfied, loss of a firm can be carried forward by a company, loss of a company can be carried forward by LLP. Remember, MAT credit cannot be carried forward. Remember, MAT credit cannot be carried forward. Okay, MAT credit cannot be carried forward. Right. So then if we look at the law, then it goes to from a set of there is no specific deductions for them, and then the law goes to transfer pricing chapters, then comes the administrative provision, that is are all same for everything. Section 139 says if the firm is subjected to audit, even the partners can file their due date by 31st of October, that we know. Okay, so from there if we travel down 139 1 and then go to assessment procedure remains the same for everyone. Then we go for that special liability case. Special liability where who is liable for what? Okay, sir, a partnership firm dissolved. A partnership firm dissolved. Is the tax not collectible? No. Okay, the partners are jointly and severally liable. The income tax officer will just catch hold of one partner at the time of retirement, at the time of dissolution, and say, you pay the full tax, because partners are jointly and severally liable. All the partners are jointly and severally liable. Where a firm is dissolved, then the partners in the year of dissolution are liable to for any dues under this law. Legal heir of the partner will be to the extent estate is inherited. So that is what the partnership law's parent wording, joint and several liability. If we cross that, there is no specific TDS aspects, there is no specific 234 ABC, everything is common. Okay, and then if we move on, then we don't have anything specific for the firm. Okay, so these are all the specific provisions, and section 194A, TDS is not applicable for interest on capital, but section 195, if the partner is a non-resident, it is applicable. Tax rate of a partnership firm is 30%, base rate 12% surcharge if the amount exceeds 1 crore, that is the income exceeds 1 crore, and HEC is 4%. Okay, so these are all the things which partnership firm has. Focuses on remembrance is on focus illa. Okay, if you listen to it once, whatever we have so far, that is more than enough. PGBP section 40B, capital gains has 4 provisions. Set off as a specific provision, share of loss of retiring or deceased partner cannot be carried forward by the firm. Somebody was asking me about
Sir.
listening.
Sir, what is that assessment under section 154, sir?
Rectification of mistakes, sir.
Is that? Oh, okay,
Rectification
okay.
of mistakes, sir. Assessment can be carried out in the hands of the partner in the case of dissolution of a firm. That's what I said, the special liability.
Okay.
Okay, these are all the specific provisions of the firm which will help us to understand firm on a global manner. Otherwise, it's general PGBP. Otherwise, it's general PGBP. With these specific provisions in this in our mind, let us go and understand some of the questions. Let us go and answer in assessment of firm. Question number 1. Any transfer of capital asset or intangible asset by a private limited company or unlisted company to a LLP, or any transfer of shares or shares held in by a company in a company by a shareholder on conversion into LLP in accordance with 56 and 57 of LLP Act shall not be regarded as transfer for the purpose of levy of capital gain under section 45, subject to fulfillment of certain condition. Explain the construct, the provision therein. Okay, as I told you, the when will it not be? It's an examination question. I am answering only examination questions. Okay, it is the same. I am just copying and pasting it here. Okay, this is what is being asked. Okay, what are all the conditions to be fulfilled? Okay, these are all the conditions to be fulfilled for a firm for a conversion of a private limited company or an unlisted company. When the provision was introduced, this question came. Not that they are asking such question. The partnership deed of a firm does not specify the remuneration payable to each individual working partner, but lays down the manner of fixing the remuneration as follows. In the case of book profit of the firm are up to 3 lakhs, then the partners would be entitled to a remuneration of 150 or 90%. Whatever is there in 40B, they have written. Okay. In case there is a loss, the partner shall not be entitled. Remuneration payable to the working partner should be credited to the respective account at the time of closing of the accounting year, and the working partner shall pay. Can the firm claim deduction in respect of the remuneration? So they have just mentioned what is there in the partnership law, in the income tax law as remuneration. In such circumstances, will they be eligible for remuneration, or should the partner should the deed specify clearly what is? No, in the case of Anil Hardware, in the case of Anil Hardware, my dear friends, okay, held by the High Court that the quantum need not be a certain sum of money but can be based on certain limit. Partners, in order to avoid a conflict between the deed and law, they can mention the restrictions in 40B is applicable for books of accounts as well, and it will be applicable. AO is not justified in disallowing that quantum. AO is not justified in disallowing the quantum. Okay, so I'm writing question number 2. Refer Anil Hardware case. Okay, Anil Hardware case. Okay, where the judgment you have it, the judgment you have it. Okay, you have the judgment here. Sorry, here. Okay, you can say that it is in the page number 24 also. So in order to save time, I'm not writing the judgment. I'm just asking you to refer Anil Hardware case. Okay, shall I move on? Okay, third question. X and Co., a partnership firm consisting of 3 partners, enhanced working partner's salary from 25,000 per month to each partner to 50,000 for each partner. The increase in working partner salary was authorized by the D. The assessing officer during the course of the assessment contended that the remuneration paid to the working capital, that is 50,000 for each partner, as excessive and applied 40A2, though the payment was within the statutory limit of 40B. Decide on the correctness of the assessing officer, CA Institute. If they question like that, that means assessing officer is wrong. I don't know why. But okay. So generally, okay, we know that the case law also, great city manufacturing. But before that, let me write this particular part so that somewhere here also it gets told. Okay, question number 3. Okay, where there is an amendment to the deed, such amendment will be applicable prospectively and not retrospectively. Okay, such amendment. So I'm just writing this for this purpose. Otherwise, this case has nothing to do with this. Since the word amended, it has been increased. I thought somewhere I can put it in the revision material also, so that it is holistically clear to you. Okay, now coming back here, I am picking up a case called Great City Manufacturing Company, held by High Court, that when section 40B specifies the limitation, then that becomes the fair market value. AO cannot assume any other basis of determining the fair market value. Hence, the AO's action is not valid. Hence, the AO's action is not valid. So, refer Great City Manufacturing Co. Okay, it's there in the firm itself. Okay, you can easily refer, so that just save some time for us. Okay, then question number 4. ST and Co., the partnership firm, was dissolved, and as per the dissolution deed of the partnership firm, with effect from 18th September, sorry, I should have changed the date, but since the question is as it is, I maintained it, I should have changed the date. Yes, one of the partners, that 18 September 2020, yes, one of the partners of the erstwhile firm took over the entire business of the partnership firm in his individual capacity, including fixed assets, current assets, liabilities, and other partners was paid their dues. He then continued the business of the sole proprietor with effect from that date. The assessor, relying upon section 78 subsection 2, claimed the set-off of loss suffered by the erstwhile partnership firm against his income earned as individual proprietor, considering the case as inheritance. Inheritance not succession. It is only for amalgamation, demerger, firm into a company, company into LLP. It is not for firm into sole proprietor at all. The claim of the assessee was disallowed by the assessing officer. Examine the correctness. Okay. Question number 4. Where there is dissolution of a firm, the loss pertaining to the retiring or deceased or any of the partners cannot be carried forward. Okay, in the case if you have dissolved the firm's loss is lost. It cannot be carried forward. The fundamental guiding principle is loss can be carried forward and set off only by the same person. Okay, exceptions can be there. Okay, exceptions are only this reconstitutions like amalgamation, demerger, all exceptions. But generally, okay, this is the fundamental loss. Loss can be carried forward and set off only by the same person who incurred that loss. Only by the same person who incurred that loss. Okay, right? Firm dissolved. and a partner taking over the activity is not an exception mentioned therein. Hence, Mr. S cannot carry forward such laws. Hence, Mr. S cannot carry forward such laws. இது ஒரு case law இருந்தது Pramod Mittal. That case law has been removed from our examination. So let's not even worry about it. Just understand the provision. That is more than enough. That is more than enough. Raja Kailash inherited as a co-owner plinth which he offered to tax under income from house property. AO taxed the income under the same head but treating the co-owners as AOP. Comment. Okay. This there is Sudhir Nagpal. Sudhir Nagpal craze. Okay. Neither it is IHP nor it is a AOP only when the shares are indeterminate. When the shares are determinate, okay, not only in this case law, in one other case law also you will see it will be taxable only treating them as an individual and not as AOP. Held by the High Court that the income from letting out of plinth assessable under section 56 as IFOS and not under IHP. So first mistake is it is taxable only under IFOS. Co-owners have inherited the property from their ancestor and there is nothing to show that they have acted upon as AOP. Therefore, it is held that the rental income from plinth should be assessed in the capacity of individuals and not as AOP, and consequently the 167B is AOP provision would not get attracted, okay. Question number 5 refer to Sudhir Nagpal. Okay, in short, if you want, okay, letting out of plinth is only under IFOS and not IHP. There is nothing to specify that an AOP has been formed. Okay, rental income is taxable in the hands of members in individual capacity and not as AOP. Okay, you can refer to that case law where this is the crux of the issue. Question number 6. Partners introduced the capital into the firm. The partners were unable to specify the source of investing such capital. AO proceeded against the firm and taxed the unexplained cash credit in the hands of the firm, which is wrong. Firm has defined it. Firm has said what is their source. The firm has said that the source of their income is partners. That the source of their income is partners. The source of their receipt is partner. It is the partner who is unable to mention and it cannot be taxable in the hands of the firm. Okay, M. Venkateshwara Rao. Okay. Okay, partners introduced the capital into the firm. The partners were unable to specify the source. AO proceeded against the firm, held by the High Court that any proceeding against such unexplained source can only be against the partners and not against the firm. The firm has explained the source. எனக்கு partner கொடுத்தாங்க. Only the partners have failed to give a reasonable explanation. Hence, any proceedings under section 68 can only be against the partners. Okay. Okay, refer Venkateswara Rao case, you will get the judgment. You will get the judgment. Okay, right. Now going to question number 7. PQR Limited, a LLP set up in special economic zone in the financial year 1617 for production of washing machine. Set up in 1617, 1617, 1718, 1819, 1920, 2021. We are in the 5th year. Why am I doing it? Because SEZ means section 10AA. SEZ means section 10AA. If in the case of section 10AA, what is the provision? The section 10AA says that export profit is available for exemption. Export profit means total profit into ET by TT. ET stands for export turnover, TT stands for total turnover. Export turnover means money brought into India. Money brought into India. So, ET by TT. For if it is in the first 5 years of operation, 100% of the profits is exempt. Next 5 years, 50%. Okay, considering this, that's why I counted. The unit fulfills all the conditions of section 10AA, okay, of Income Tax Act. They will give you in the examination also like this. During the year 1920, it has also set up a warehousing facility in the district of Tamil Nadu for storage of agricultural produce. It fulfills all the conditions of 35 AD. Capital expenditure in respect of warehouse 75 lakhs, out of which 10 lakhs is cost of land. The warehouse became operational during the current year and the expenditure of 75 lakhs was actually capitalized in the books. Okay, the relevant details are profit of SEZ, export turnover, domestic turnover, profit before claiming 35 AD, compute income tax, including AMT. Even if they don't say, we are going to do that. Okay, a question to recollect AMT also. A question to recollect AMT also. When will AMT be applicable? 3 things you have to remember to just know when will AMT be applicable. Number 1, you have to remember if there is 35 AD, AMT is applicable. If there is 80 Is, AMT is applicable. If there is 10 AA, AMT is applicable. Once more, 10 AA, AMT is applicable. 80 Is, AMT will be applicable. And section 35 AD, AMT will be applicable. If you remember this, it's more than sufficient. Question number 7. Okay, let me start with the first, the normal provision. Computation of total income of the firm. Computation of total income of the firm. These decorations will not be continuous. Just for one question I'm doing it. Okay, right. Okay, unit located in SEZ or unit qualifying for 10AA, whatever you want to write, you can write. Profit before claiming exemption. Profit before claiming exemption. Okay, 40 lakhs. Profit before claiming exemption, 40 lakhs. Less exempt under section 10AA. Okay, right. Export 100% of export profit. Okay, export profit is equal to total profit into ET by TT. Okay, total profit into ET by TT. So let me now compute the total profit. Total profit is 40 lakhs, ET is 80 lakhs, and domestic sales 20 lakhs. Total turnover is 100 lakhs. So 40 lakhs into 80 by 100. Okay, 100% can be claimed. So since it is in the first 5 years of operation, okay, 100% can be claimed. Okay, I'll write here first 5 years of operation. So 100% can be claimed 8 lakhs. Okay, second, okay, specified business profit before claiming 35 AD, 1 crore 5 lakhs. Okay, less. Okay, expenditure under 35 AD other than cost of land. Expenditure under 35 AD other than cost of land. I believe it is 65 lakhs because 75 lakhs is the total expenditure and 10 lakhs is cost of land. So you can write a small extra note here, okay, to make the examiner understand that you know the provision. Expenditure will be accumulated and claimed in the first year of operation. Though it is available from 1920, but your operation started in 2021. So 65 lakhs. Okay, okay. Total income. Total income 48 lakhs. Total income 48 lakhs. Computation of tax. Tax at the rate of 30% on total income. Tax at the rate of 30% on total income. Okay. And HEC at the rate of 4%. Total tax payable. Okay, actually total tax not payable. Total tax 1497,600. 1497,600. Whenever we say 10AA, whenever we see 35AD, whenever we see 80I, the immediate next thing we prepare is, okay, computation of adjusted total income. Computation of adjusted total income. To make it more clear, section 115JC. Okay, computation of adjusted total income. Total income after allowing all deductions, exemptions and expenditures. Total income after allowing all deductions, expenditure and exemptions. Add exemption under 10AA. Add exemption under 10AA 32 lakhs. Okay. Expenditure under 35AD. Okay. 65 lakhs. Okay. Okay. 65 lakhs. Less depreciation on asset claimed as deduction under 35AD. Okay, this is warehouse, so it is 10%. 65 lakhs into 10%. Okay, 65 lakhs into 10%. 6,50,000 less depreciation on asset claimed as deduction under 35AD. So we will add 3 items, reduce. The third item to be added is all income based exemption, income based deduction, 80I onwards, income based deduction we will add, and the only reduction is depreciation. Okay, adjusted total income. Adjusted total income. Okay, 1 crore 51 lakh 50,000. Adjusted total income 1 crore 51 lakh 50,000. Okay.
Sir,
Raja,
sir, on the 6,50,000,
sorry. Yeah, yeah, yeah. 1 crore 38 lakh 50,000. Okay. Uh, Alternative minimum tax. Alternative minimum tax. AMT at the rate of 18.5% on ATI, adjusted total income, into 18.5% into 18.5%, and surcharge at the rate of 10% into surcharge at the rate of 12%. Sorry, surcharge at the rate of 12%. Okay, into surcharge at the rate of 12%. Okay, because income has exceeded 1 crore, surcharge at the rate of 12%, and HEC at the rate of 4%, and HEC at the rate of 4%. Total AMT, total AMT. Firm is liable to pay either okay, normal tax, or either normal tax or AMT, whichever is higher. So the firm is liable to pay either normal tax, which comes to 14 lakh 97, or AMT, whichever is higher, so 29. Okay, where AMT is payable, the difference between AMT and normal tax can be carried forward as tax credit to be adjusted against normal tax payable. Period of carry forward 15 years. Period of carry forward 15 years. So this minus the normal tax will be carried forward, and this is adjusted against normal tax payable for a period of 15 years.
sir,
Listening?
sir, when you said the company is converted to LLP, we can't carry forward that credit. What about AMT credit when firm is converted to company?
You cannot carry forward, because that is also similar to MAT, and you cannot.
Okay. Sir, and one more thing, should we mention somewhere saying that since ATI exceeds 20 lakhs, so AMT is applicable? Should we mention that?
Better to say, yes, see, state the obvious in examination, nothing wrong. Yeah, you can mention. ஆனா இண்டிவிஜுவல்ஸ் அண்ட் ஹெச்யூஎஃப்க்கு தான் நினைக்கிறேன், ஒரு வாட்டி செக் பண்ணிக்கலாம். Question number 8. ABC Private Limited was converted into a LLP called ABC LLP on 1/7/2020. On 1/7/2020, you are provided with the following particulars of the private limited company: unabsorbed depreciation, business loss relating to financial year 1314, unadjusted MAT credit to the extent of 8 lakhs, written down value of asset of income tax, plant and machinery 10 lakhs, market value, plant and machinery market value is 15 lakhs. Sorry, again plant and machinery 50 lakhs. Okay, good deduction claimed under 35 AD for that. Building 20 lakhs, market value 30 lakhs. Cost of land acquired in 2006, 50 lakhs, market value 100 lakhs. Expenditure on VRS incurred by the company during the previous year 18-19, 25 lakhs. The company has been allowed deduction of 5 lakhs in the previous year 18-19 and 19-20 each. Okay, explain the treatment of above items in the hands of LLP, assuming they have satisfied all the conditions laid down in 47. All conditions satisfied. Let's go by one. Unabsorbed depreciation can be carried forward and set off by the LLP. Unabsorbed depreciation can be carried forward and set off by LLP. Okay, next is business loss of 1314. Business loss of FY 1314. Okay, business loss of financial year 1314, 1415, 1516, 1617, 1718, 1819, 1920, 2021. We are the 7th year. Okay, this loss can be carried forward by LLP and set off over the balance period. Okay, in the given case, in the next 2 years. Yes, you can carry forward, no doubt about it, but it can be set off only against in the balance period. Totally 8 years, including the conversion. Totally 8 years, including the conversion. Unadjusted MAT credit. Okay, cannot be carried forward. The basis of computation itself is different. Math or format, AMT or format. That's what the answer for our friend also. So you cannot cross carry forward. The basis itself is different. Okay. Uh, Written down value of assets. Okay, I'll come to this last. I will complete cost of land and then come to this. Okay, cost of land. Okay. The transferee entity can carry record or take over only at book values prevailing. Okay, okay. Hence, land can be recorded only at rupees 50 lakhs, whatever is the book value. That can only be the cost of land. It cannot be any other thing. It cannot be any other thing. Okay, am I clear to you? DRS compensation in 1819, 25 lakhs. Okay, here I will write the parent provision once. Okay, provisions will apply to transferee entity as it would apply to transferor had the event not happened. Okay, had there not been an amalgamation, had there not been a conversion, what will be the applicability of the provision of the transferor company will only be applicable to the transferee company as well. Okay, the balance portion of DRS compensation 15 lakhs. How 15 lakhs? 25 lakhs incurred, 10 lakhs already claimed in 2 years will be carried forward by LLP and claimed over balance 3 years. So 5 lakhs per year, they will claim for 2021, 21, 22, 22, 23. Be it amalgamation, demerger, conversion, in all these cases, it will be carried forward and then like this will be carried forward by LLP and claimed over the balance period and claimed over the balance period. Now for assets. Now for depreciable assets. Now for depreciable assets. Plant and machinery, which is claimed as deduction under 35 AD, will be recorded only at nil value. Okay, because you have already claimed the entire amount. So the plant and machinery 50 lakhs, that 35 AD plant and machinery, that you have already claimed it as deduction. So it will not be having any value in my books. It will be recorded at nil value. One additional provision I will write so that you are clear. When it is sold, the sale value will be treated as deemed income under section 41. When it is sold, any asset used for scientific research, specified business, even if it is for the successor of business, when it is sold, it will be treated as deemed income. If it is sold over and above the original cost, such excess alone will be treated as capital gains. Okay, now plant and machinery general. Okay, 1/4/2020 value, 1/4/2020 value is 10 lakhs. Only the book value 10 lakhs. Only the book value should be taken 10 lakhs. The rate of depreciation is 15%. The rate of depreciation is 15%, and the depreciation quantum will be 1,20,000. Building. Okay, 1/4/2020 value. Okay, 1/4/2020 value. The building value is 20. Building value is 20 lakhs. The building value is 20 lakhs. 10% is the rate of depreciation. 10% is the rate of depreciation. Okay, so the depreciation will be 2 lakhs. The depreciation will be 2 lakhs. Okay, the depreciation will be 2 lakhs. So total depreciation my dear friends, 1,50,000 plus 2 lakhs, 3,50,000. Total depreciation 3,50,000. Okay, right? Date of conversion, my dear friends, date of conversion 1/7/2020. Date of conversion 1/7/2020. Okay, so period of existence of company. Okay, April 30 days, May 31 days, June 30 days. Always only in days. Always only in days, please prepare it. Don't prepare 3/12, 91 days. So the company can claim a depreciation of 3,50,000 divided by 365. It's not a leap year. 365 into 91, 87,260 will be the depreciation for the company. Okay, depreciation for LLP will be, okay, 3,50,000 minus 87,260. Depreciation. Proportionate depreciation as a concept. When will proportionate depreciation come? If for the same asset, two entities need to claim depreciation, then the depreciation will be computed ignoring the event, and such computed depreciation will be apportioned between the two entities based upon the period of existence and number of days of existence. So it should be split on the basis of number of days. I have seen 2-3 times typical question with different values coming. Okay, if it comes, it's a bonus. It's a bonus. It's a sweep. Okay, it's a sweep. Okay. Okay, now let's do some questions where we are going to also look into PGBP in a different manner. Okay, question number 9. On 1/4/2020, Bino Limited of Delhi, a domestic company engaged in the manufacture of metro rail seats, converted into LLP by name Messrs. Salmia LLP, fulfilling all the conditions. Some of the relevant provisions are given below for the year ended. Actually, it should be 31. Okay, for the given below in respect of 31/3/2020. Corrected. Okay, VRS compense expenditure incurred by the company during 18-19 20 lakhs. The company has claimed 4 lakhs during 18-19 and 19-20. 150 equity shares of Toyo Limited, an Indian company listed in Bombay Stock Exchange, was acquired for 1,900 per share on 31/7/2018. On conversion, these shares became the shares of Messrs. Salmia LLP. Besides other assets transferred to Messrs. Salmia LLP by Messrs. Binu Limited, it also transferred 2 factory buildings. On 1/4/2020, Messrs. Salmia LLP leased out one of the factory building along with plant, machinery and furniture at a consolidated composite rent 50,000 per month. Not only building, they have let out building, machinery, furniture for 50,000. The income is taxable under IFOS. During the previous year 2021, Messrs. Salmia LLP earned a profit after debiting or crediting the following item. Mr. Binu is the working partner of the firm. He is also working partner of another firm. He is actively engaged in both the firm. Binu gets a salary of 55,000 from Salmia LLP and the same is authorized by the deal. Ayushman, an employee of the company, was deputed on work in client's office in Mumbai for 3 months. The LLP has paid his salary in cash for the months when he was in Mumbai, amounting to net of TDS, since he did not have bank account in Mumbai. This payment was included in salary debited to P&L. Mr. Ayushman is normally posted in Delhi. Amount of 25,000 paid towards penalty for non-fulfillment of delivery contracts for sale for the reason beyond its control. LLP has provided an amount of 18 lakh being the sum estimated as payable to workers based on the agreement to be entered with the workers union towards periodical wage revision once in 3 years. The provision is based upon fair estimation. Okay, okay. ICDS 10, where it is the estimation is on a scientific basis, reasonable certainty is there. It is now allowed. Though it is a provision, it is now allowed. ஒரு ஒரு குவாண்டம்காக சொல்றேன், மிஸ் பண்ணிட்டேன். டிப்ரிசியேஷன் டெபிட்டட் இன் P&L ஒரு 10 lakhs னு வெச்சுங்களேன். ஒரு குவாண்டம்காக தான். Don't take it in literal words. Okay, just ஒரு quantum. Gratuity provision based on actuarial valuation is 6.5 lakhs. Gratuity actually paid is 4 lakh to retained employee debiting the provision account. Profit on sale of Messrs. Toyo Limited. These shares were sold on 31/5/20 for 2750. The highest price of Toyo Limited quoted in stock exchange on 31/1/2018 was 2,200 per share. Repairs to plant and machinery include 59,000 in respect of plant and machinery given on lease. Factory license paid rupees 15,000 for each factory building. Legal fees includes 26,000 paid to an advocate for drafting and registering the lease agreement. Additional information. Under an agreement of debt restructuring, the bank has converted unpaid interest amounting to up to 31/7 into a new loan repayable in 3 equal installments. The first installment was paid in March 2020 by debiting the new loan account. I will I'll fill it up. When I am doing the question, I'll fill it up. Mr. Binu, being a working partner, bought a car which is registered in his own name out of the funds of LLP, A. Sivakami and Co. The car was used exclusively for the business of LLP. The depreciation of the car amounted to 15,000, which is not included in the depreciation debited to P&L. Depreciation as per income tax law 8,10,000, including depreciation amount given on lease. It does not include depreciation on car. The LLP sold import entitlement 150. The sum is not included in the profit and loss by treating it as capital reserve. You are discussed to implication. Calculate the income of the LLP. Fantastic. We will do it so that we are covering PGBP also, some provisions. Okay, as usual, together we are doing, no time wasting. so that we are able to complete it with understanding each and every aspect of the question. Okay, computation of income of Salmia LLP for AY 21-22. Okay, net profit as per profit and loss account. Net profit as per profit and loss account. Okay, it comes to oh, um, okay, I'm just assuming the numbers because that is not the important, even tax is not the important, provisional understanding, so please don't mind those okay, okay, net profit as per okay, not assumed. Okay, okay, let me assume 50 lakhs. Okay, not 50 lakhs, let's எவ்வளோ salary கொடுத்திருக்காங்க 55,000. Okay, so let's assume some 12 lakhs. Okay, this is just an assumption, I'm very sorry. Okay, adjustments, adjustments. Okay, from the top I will come for the adjustments. VRS comparative, VRS expenditure incurred by the company. Okay, right, so from there I'll come to the adjustment. One minute, I'll close one of the files so that I'm able to toggle easily. Okay, right, right. Okay, so in this case, okay, VRS compensation paid by the company, the unabsorbed amount carried forward by LLP, which needs to be written off over the remaining period. Over the remaining period, that will be minus 4 lakhs. You can charge that 4 lakhs. You can charge this 4 lakhs. This we will come to it later. Okay, okay. Besides this, it is also transferred to factory, leased out one factory with plant and machinery at a consolidated rent of 50,000 per month. Okay, lease rent. Okay, composite rent. Okay, taxable under IFOS. Okay, 50,000 per month into 12, 6 lakhs. 50,000 per month into 12, 6 lakhs. Okay, it is taxable somewhere else. Okay, remuneration to partner. Okay, we will deal with it separately. We will deal with it separately. After finding out our book profit, we will deal with it. 6,60,000. 6,60,000. Ayushman, an employee, was deputed and his salary was paid. Okay, okay. This is an exception mentioned under Rule 6DD. Rule 6DD exception. Okay, where an employee is posted outside the base location for a temporary period. The law itself says what is temporary period. Okay, max 3 months. That is what is temporary period. Then the salary can be paid to such employee in cash, and it will not amount to disallowance. Okay, this will not amount to disallowance, nothing to disallow. Rule 6DD specifies the exceptions. You need not disallow it. You need not disallow it. Okay, okay, right, fine. Okay, so this 40,000, there is no disallowance. Amount of 25,000 was paid towards penalty for non-fulfillment of delivery condition. Penalty is violation of law. Penalty means violation of law. non-fulfillment of delivery terms is like a compensation. It is not treated as penalty. It is like a compensation. So it is allowed as an expenditure. This is not a penalty. Okay. Non-fulfillment of terms of contract and the quantum paid is in the nature of compensation and not penalty, hence allowed. Okay, there is nothing to disallow. Penalty na violation of law. Okay, here it is violation of contractual terms which is happening. For the receiver it is business income. Compensation received is business income. So for the receiver it is income. Okay, இதுவும் நான் assume பண்ணிக்கிறேன் ஒரு 10 lakhs னு. Okay, depreciation as per books assumed 10 lakhs. Okay, gratuity, provision for gratuity 6,50,000, actual provision 650, actual gratuity paid 4 lakhs, actual gratuity paid. Okay, provision add back, actual gratuity reduce. Okay, profit on sale of listed shares taxable under capital gains. For us it is taxable under capital gains. Okay, the profit on sale of these shares are sold for 2750. Okay, okay, these shares are sold for 2750. எவ்வளவு ரூபாய்க்கு வாங்கினோம்? There are 150 equity shares. I purchased for 1900 and I sold for 2750. I sold it for 2750. So, okay, 150 into 2750 minus 1900. Okay, 1,27,500. This is the profit, should be reduction. Okay, it should be reduced because it is taxable under capital gains. It is not a business income. It is taxable under capital gains. Repairs to plant and machinery include 59,000 for plant and machinery. Okay, repairs of leased plant, not a business expenditure. Not a business expenditure. So you disallow. Okay, 59,000. 59,000. Factory license paid rupees 15,000 for each factory building. License fees paid for leased factory, not a business expenditure. Okay, 15,000. License fees paid for leased factory, not a business expenditure, 15,000. Legal fees 26,000 for drafting lease. Legal fees for lease agreement, okay, paid to a lawyer. How much is that? 26,000. 26,000. My dear friends, these are allowed under PGB IFOS, but it is here, it is not considered as business expenditure. Okay, okay. So third assumption also I am taking now. Third assumption also, I know it's not right, but still please. Okay, interest paid on, okay, interest paid on term loan, debt restructuring and the underpaid interest. Okay, okay, interest paid during the year for restructuring loan. Such interest would have been disallowed in the earlier years under 43B. So, under 43B, these interests would have been disallowed. Now, they say under an agreement, the bank has converted unpaid interest into a new loan payable in 3 equal installments, and one installment is paid before the in March 2021. One installment is paid in March 2021. one installment is paid in March 2021. For example, I am taking it as 3 lakhs divided by 3. Okay, for example, I am taking it as 3 lakhs divided by 3. Okay, taking it as 1 lakh per month per installment. So that 1 lakh will be allowed, because in the earlier years it would have been disallowed under 43B. In the year of payment it will be allowed. Okay, Mr. Binu is a working partner, bought a car. The car is used exclusively. The depreciation amounted to 15,000, which is not included. Okay, depreciation as per IT law for other assets less leased asset. Okay, for other assets less the leased asset, 8 lakh 10 minus 90,000. 8 lakh 10,000 minus 90,000. Okay, 720 for car. Okay, A. Sivakami and Co. Okay, beneficial owner can claim depreciation. Okay, 15,000. So total depreciation 7,35,000. Are we over with all adjustments? Are we over with all adjustment? So the book profit I get, the book profit I get is, the book profit I get is, I have made some assumptions, so I know book profit 12 lakh 47,500. 12 lakh 47,500. Okay, less maximum permissible remuneration, less maximum permissible remuneration. As per deed, we all know 55,000 into 12. Binu, the partner, will get 55,000 into 12. As per act, look at the working. Okay, 3 lakhs into 90% plus 1247 300 la 9 3 lakhs paitana 9 lakh 47 500 into 60%. Okay, repeating. Okay, 12 lakh 47 500 minus 3 lakhs into 60% plus 2 lakh 70,000. That is for the first 9 lakh. Okay, so maximum permissible remuneration is whichever is less, either as per deed or as per law. Okay, whichever is less. So 66 lakh 60,000. 6 lakh 60,000. So business income. Business income is, my dear friends, 5,87,500. Business income is 5,87,500. Majorly, I have done only PGBP. Partnership related here and there only I am doing. Okay, and that's what the question also will be. Okay, it will be PGBP cannot be a separate question with lesser marks. Okay, okay, computation of total income. Computation of total income. Okay, business or profession. Business or profession. Okay, business income as computed. Business income as computed 5,87,500. 5,87,500. Okay, capital gains. Sale of listed shares. Sale value of listed shares. 150 shares sold at 2750. 150 shares sold at 2750. You can see the question. It is 2750. Cost of acquisition. Cost of acquisition. What is the purchase price of these shares? cost of acquisition 150 into 1900 because this is purchased after 31,118. Before 31,118, I will see which is higher. It is purchased on 31/7/2018. Look at the question. It is purchased on 31/7/2018. These shares, okay, my dear friends, are purchased after 31/1/2018. So I will take the actual cost only. 150 into 1900. Okay, long-term capital gain, okay, assuming STT, because these are sold through recognized stock exchange, assuming STT is paid, because no indexation benefit if STT is paid, okay, taxable under section 112A will be 1,27,500 minus 1 lakh. The first 1 lakh is exempt. The balance is taxable under 10%. The first 1 lakh is exempt. The balance is taxable at 10%. So only 27,500 becomes taxable. Only 27,500 becomes taxable. Other sources, okay, other sources, lease rental income, that is also composite rent, okay, it is 50,000 into 12, 6 lakhs less allowable expenditure, less allowable expenditure. We all know against the lease we can claim the expenditure. Here it starts repairs 59,000, repairs 59,000, okay, repairs 59,000, factory license 15,000, factory license 15,000, legal fees 26,000, legal fees 26,000, depreciation 90,000. Okay, what is the income from IFOS? What is the income from IFOS? Okay, 4,10,000. Therefore, total income. Okay, you can even call it gross total income slash total income because there are no deductions I see. Okay, so is 10,25,000, 10,25,000, 10,25,000. You are required the implication and the total income in the hands. Only the total income, not okay. Every item you can write the working note and complete it. Every item, okay. 90% of the answer you know. I assure you that 90% of the answer எல்லாமே examination questions தான் இதுக்கப்புறம் நான் போடுறது. Okay, or similar to examination, I might have made small amendments. Okay, similar to examination question only I do. 90% of the answer you will do without my help. Only thing that you will lack is not preparation, your confidence. Ayyo, whether I am right, ayyo, whether if you go and do it, you will be definitely right. Have that confidence and approach whatever may be the question. Have that confidence and approach. Okay, right? Hindu Udyog, a manufacturing partnership firm. Additional depreciation will come if at all there, because the manufacturing vanda adu nyamam vechukonu. Consists of 3 partners X, Y and Z, provides the following information relating to the year. Net profit of 28.75 lakhs as per P&L was arrived after debiting or crediting the following. The firm has provided 2 lakhs being sum estimated as payable to workers against there itself it was there, but I think I skipped that line. This I should have that wage revision line. In this question, I'll do. Okay. Net profit of 28.75 as per P&L was arrived at after debiting or crediting the following. The firm has provided 2 lakhs being sum estimated as payable to workers based on agreement to be entered with the workers union towards periodical wage revision once in 3 years. It is allowed. Sale proceeds of import entitlement amounting to 1 lakh has been credited to P&L, which the firm claims as capital receipt. No, it is a revenue receipt. Okay, goods and service tax demand paid includes 5,300 charged as penalty for delay in payment, 12,750 towards interest. A free air ticket was provided by a supplier for reaching a certain volume of purchase being during FY 2021. The same is not credited to P&L account because it was encashed only in April 21. Interest amounting to rupees 20,000 paid to X as a Karta of HOF 18%. The firm has taken on lease an old building for the purpose of locating its business. Due to the old age, it was demolished and a new building which was used by the firm. The cost of new building 10 lakhs was written off as revenue expenditure. Lessor permitted 20 years lease extension. Loss incurred in the transaction of purchase and sale of shares without delivery of various companies 3 lakhs. A scheduled bank sanctioned and disbursed a term loan in the financial year 16-17 for 50 lakh. Interest of 8 lakhs was in arrears. The bank has converted the arrears of interest into a new loan repayable in 10 equal installments. During the year, the company paid 2 installments and debited it to fund account. The firm furnishes the following additional information. Provision for audit fees 2.5 lakhs was made for the year ended 31/3/2020 without deducting tax at source. Such fees was paid in September 2020 after deducting 194J and the tax was deposited on 7th October 2020. Last year you would have disallowed 30%, allow it in the year 2021. The firm had made an investment of 23 lakhs and 12 lakhs on the construction of 2 warehouses excluding cost of land in a rural area for the purpose of storage of agricultural produce and edible oil respectively. These were made available for use from 15/9/2020. The profit from setting out of these warehouses are 15 lakhs and 5 lakhs respectively before claiming 35 AD and 32. Agricultural produce is 35 AD. They themselves will give, and this is normal depreciation needs to be claimed. In July 2020, the firm received a dividend of 11 lakhs from A Limited, in which it holds 10% of shares. The firm till the financial year 1920 had 4 equal partners, W, X, Y and Z. W retired on 31st March 2020. He was settled on 11th January 2021 by transfer of land which was purchased in 1617 for 11 lakhs. Stamp value on the date of transfer is 26 lakhs. Business loss brought forward 6 lakhs and unabsorbed depreciation 16 lakhs. Compute the total income of the firm by analyzing, integrating and applying the provisions of income tax law in brief. Give the various treatments. There is no remuneration or interest. So the question is more to do with PGBP and the related capital gains, but it is one of the finest question we are going to work with. Okay, question number 10. Computation of business income. First, I'm manufacturing business, and then we'll do the specified business separately. Manufacturing business. Net profit as per profit and loss account 28,75,000. Net profit as per profit and loss account 28,75,000. Okay. Provision for wage revision. According to ICDS 10, where the provision is on scientific basis slash past experience and reasonable, then the same will be allowed. Then the same will be allowed, nothing to disallow. Okay, please remember this adjustment, it is allowed. Okay, sale of import entitlement. Any export incentive received will be, okay, treated as business income under section 28. So the company's contention that it is a capital reserve is not correct. So it is definitely a business receipt. The company's contention that it is a capital receipt is not correct, my dear friends. GST demand includes 5,300 as penalty. This will be disallowed. This will be disallowed, whereas interest will be allowed. Interest is not in the character of penalty. It is not ultra vires. This is not violation of law. Okay, penalty paid under GST law will be disallowed, my dear friends. 5,300. Interest paid will not take the character of penalty, hence allowed. There is no disallowance for interest. Interest paid will not take the character of penalty. Okay. According to section 28, perquisite. Okay, perquisite is taxable in the hands of the receiver under this head. Okay, it is taxable on accrual basis. So you need to add this perquisite of a fee ticket by FACRE for achieving certain value. Okay, rupees 2 lakhs. The monetary, whether convertible into money or not, it will be taxable. In this case, they have converted it, but later only they have converted it. So it will be taxable. Interest amounting to 20,000 into X. Okay, interest to partner in representative capacity. Interest to partner in representative capacity. Interest to partner in representative capacity will be covered under 40A subsection 2. Okay, it is assumed that the interest paid is as per FMV, hence no disallowance. Up to 18%, don't worry. In exam also, they are only checking the theoretical understanding of this provision. So don't worry, no disallowance. Okay, hence no disallowance. Okay, building charged to P&L account. Okay, there is an extension of lease for 20 years, so it should be capitalized. Okay, less depreciation at the rate of 10%, depreciation at the rate of 10% as it is used for more than 180 days. It's in September itself, so 1 lakh depreciation should be allowed. 1 lakh depreciation should be allowed. Okay, depreciation at the rate of 10%, 1 lakh. Okay, loss incurred, speculation loss to be carried forward and set off only against the speculation income is 3 lakhs. Without delivery of goods, without actual delivery is known as speculation loss. It can be carried forward and set off only against. Okay. Restructuring of interest. Such interest would have been disallowed. Such interest would have been disallowed in the year of incurrence under 43B. The same should be allowed in the year of payment. The same should be allowed in the year of payment. In the present case, okay, 2 installments. Then during the year, the company paid 2 installments. Okay, 2 installments are paid. So, my dear friends, 8 lakhs divided by 10 into 2. Repeating, 8 lakhs divided by 10 into 2, 1,60,000 is allowed. 1,60,000 is allowed. 1,60,000 is allowed. The firm furnishes the following additional information. 30% of audit fees, as there was a tedious default in the financial year 1920, which is rectified in 2021. So, 30% of audit fees, 2,50,000 into 30%. 75,000, which would have been disallowed in the last year, now it is allowed. 75,000, which would have been disallowed in the last year, now it is allowed. Okay, I'll come to this other business. In July 2020, the firm received 11 lakhs. The firm furnishes the following additional information because it is not said debited or credited. It is not said debited or credited. Let us not consider it as credited. Let us not consider it. If it is credited, they would have taken it up. Okay, so let us consider these are additional information. Okay, the firm in 1920 had 4 equal partners. Fine. Okay, that also I will deal with it. Okay, now business income. 40,45,300 brought forward business loss. Okay, brought forward the loss pertaining to retiring partner cannot be carried forward and adjusted by the firm. So what happens, even though the brought forward loss is 6 lakhs, out of the 4 partners, okay, 4 equal partners, out of the 4 equal partners, W retired in the last year itself. So 6 lakhs divided by 4 into 3 partners only the firm can claim. 6 lakhs into 3 by 4. 4,50,000. That 1,50,000 cannot be adjusted. Loss of the retiring partners cannot be carried forward and set off by the firm. Whereas brought forward unabsorbed depreciation can be fully claimed. That is only for loss, and this provision is not available for unabsorbed depreciation. 16 lakhs. 16 lakhs. Okay. Manufacturing business income. Manufacturing business income is 19 lakh 95,300. 19 lakh 95,300 manufacturing business income. Again, majority of the adjustments you would have done it. Majority of the adjustments you would have done it. Probably you would not have written a full notes, etc. But none of these adjustments are something new to you. None of these adjustments are something new to you. Be very, very confident. Be very, very confident. If your answer is 75% right, you are getting 60% of the marks of that question. 75 and 75% sure right இருக்கும் 90% right இருக்கும்ன்றது எனக்கு நம்பிக்கை இருக்கு but come say come minimum you will be getting 75% correctly. Okay, computation of total income, computation of total income. Okay, manufacturing business as computed. Okay, 19,95,300. Specified business. Specified business. Okay. Our dance class. Profit before claiming section 35 AD. Profit before claiming section 35 AD 15 lakhs. Less 35 AD expenditure. Less 35 AD expenditure 23 lakhs. Loss to be carried forward and set off only against specified business income. Loss to be carried forward and set off only against specified business income 8 lakhs. This you cannot set it off against your normal manufacturing business. You can carry forward and set it off only against the other specified business. Okay. Okay. Third one is edible oil. Profit before claiming depreciation. Profit before claiming depreciation 5 lakhs. Yes. Depreciation at the rate of 10% on building because it is said as warehouse. The company has made 23 construction of 2 warehouses excluding cost of land. So 12 lakhs. Okay, and it is 15/9, so more than 180 days. Okay, 12 lakhs into 10%, 1,20,000. So the profit will be 3,80,000 from edible oil. Repeating, manufacturing we worked out. Specified is to be carried forward, and edible oil which can be adjusted. Okay, now capital gains. Why will capital gain come? Where firm distributes asset to partner, then capital gain arises in the year of distribution, not in the year the partner retired. Okay, in this case full value of consideration of land given to partner W. Okay, full value of consideration for land given to partner W. Okay, nothing but the fair market value. Stamp value on the date of transfer 26 lakhs. Stamp value on the date of transfer because it is settled on 11th January 21, 26 lakhs. Okay, make it more clear. Okay, FMV on date of distribution. In this case, stamp value. Okay, right? Less ICOA, indexed cost of acquisition. This was purchased in the year 1617 for 11 lakhs. Okay, 11 lakhs into 301. Can anybody tell me quickly what is 1617? Material எல்லாம் வச்சிருப்பீங்க. Quickly, can somebody tell me?
264.
Thank you very much. 264. Okay, 11 lakhs into 301 divided by 264. Okay, gross LTCG. Gross LTCG, this amount. Okay, and other sources. Now dividend is taxable. Dividend, okay, income. Okay, now it is taxable, my dear friends. போன வருஷம்லாம் இந்த provision 11 lakhs, 10 lakhs is not taxable, 1 lakh is taxable. இப்போ entire 11 lakhs. 20% we know that limitation. Okay. Okay. So this is the gross total income slash total income of the firm. I'll check and get back to you, Lalita. Sure. Okay, that is one other question which makes us stronger in PGBP. Okay, with that I complete assessment of firm. Assessment of firmல நீங்க ஞாபகம் வச்சுக்க வேண்டியது special provision. What is there in capital gains? Set off of loss by the partner who is retiring or deceased is not allowed. Okay. And then if the firm gets converted into a company converted into LLPs, okay, and also the remuneration computation. Otherwise, firm question will be more like PGBP question only. I have only worked out examination questions. Okay, so repeatedly 48.2, 48.3, all these things only. They are not going to test something out of the box and all. Import entitlement license, wage revision, all these things will be repeatedly asked, and the questions will be revolving around this only. Just feel confident. Take a small break. I understand it's a dinner break. Yeah, time is 8. Absolutely. 8:20 we will be back. I'll also take the break. 8:20 we will be back, and we are going to do one other sure short questionable area, assessment of charitable trust, once you're back, so that we have the other capital gains coming up tomorrow morning. Meet you in 20 minutes to start with assessment of charitable trust. We are going to the next area of our revision. Again, a sure short question, and very simply we can sweep the question. Okay, it is assessment of charitable trust. Assessment of charitable trust. Okay, that is the arena which we are going to focus upon now. Okay. What is a charitable trust, or what constitutes a charitable trust, etc. Okay, a quick revision of the provisions. A quick revision of the provisions so that we are more clear about it. Okay. Okay. Assessment of charitable trust. Section 2, subsection 15 tells us what is a charitable trust or what it is. It lists out the activities as relief for poor, education, medical, preservation of environment including wildlife and water bodies, preservation of monument and historic importance, places of historic importance, yoga. Up to this specific, up to this they are specific. Relief for poor, education, medical, preservation of monuments, wildlife and water bodies, preservation of historic place of historic importance, yoga. Up to this specific, where the business income can be any amount. Okay, the only condition is use it for the purpose of object of the trust. And then comes objects of general public utility. Object of general public utility, where there is a restriction on carrying on of business. Where there is a restriction on carrying on of business or the business income, there is a restriction. Okay, restriction is for trading receipt or fees in respect of a trust falling under object of general public utility. It should not exceed 20% of gross receipts. It should not exceed 20% of gross receipt. Where it exceeds, only for that year exemption is withdrawn. Only for that year exemption is withdrawn, not for wholly, only for that year. Where it exceeds, exemption will be withdrawn only for that year where it exceeds. So an assessment of charitable trust. The charitable trust or charitable activity means relief for poor, medical, education, yoga, preservation of environment, wildlife and water bodies, preservation of monument and places of historical importance, where the entire income is exempt if you use the money for the object of the trust. In the case of in the case of trust falling under objects of general public utility, there is a restriction on the total business income. It should not exceed 20% of total income. There are two exemption provisions, actually now three: 1023C, 1011 and 1046. It's just a government institution. 1023C, the easiest to remember. Three things remember there. Educational institution, hospitals whose gross receipt does not exceed 1 crore. Educational institutions and hospitals whose gross receipt does not exceed 1 crore. Okay, and then government institutions, both 1023C and 1046 speaks about government aided institutions in 1023C, government institution itself, and 11. Okay, what can be the income of this charitable trust? Okay, what are all the nature of income they can earn? Their primary income is from donation. Their primary income is donation. Donations is classified into three. Okay, donations forming part of corpus will not be treated as income. Donation forming part of corpus will not be treated as income. Anonymous donation is separately taxable under section 115 BBC. Anonymous donation is separately taxable under 115 BBC. All other donations are taxable here. Income, all other. So donations into 3. Corpus donations not an income. Anonymous donation separately taxable. It is taxable at the rate of 30% on the amount exceeding 1 lakh or 5% of donation. We will come to that. And a normal donation. Then income from property, all types of income, any type of income, dividend, interest, royalty, house rent, every type of income is income from property. Property means any asset held by the trust. Okay. Business income will also be there where you cannot exceed 20%, and capital gains. At least 85% of the amount should be utilized for the object of the trust. At least, so 15% is standard deduction. 85% should be utilized for the object of the trust. Utilization can be anything. Expenditure incurred for the object of the trust. Normal, okay. Purchase of asset, where asset can be claimed as the utilization. Depreciation is not allowed. Repayment of loan is utilization. Scholarship provided is utilization. And remember this point. Contribution or donation to another registered charitable trust. Contribution or donation to another registered charitable trust. However, where the contribution is made with the instruction that it will form the corpus of the other trust, then it will not be utilization. Onnudiya expenditure should be other person's income. You are donating and he is not taking it as income, he is taking it as corpus fund, that will not be allowed. So, where the contribution is made with a direction that it will form part of the corpus of the other trust, then it will not be known as donation. It will not be treated as utilization. It will not be treated as utilization. Till financial year 1920, they mentioned where, okay, I'm repeating. However, where the contribution is made with the direction that it will form part of the corpus of the other trust under section 11. Under section 11. So what people did, they gave it to donation to a trust registered under 1023C. Small schools, hospitals, and said it will form part of corpus of that trust. So that it need not be recorded as income because this section said section 11. There is an amendment which came in. Okay, the small amendments which I told you I'm not covering in my amendments class. Okay, the corpus donation to any trust, fund or university or education institution or hospital, other medical, claiming exemption under 1023C will also not qualify for deduction. So now the amendment is not only section 11. If you are donating to another trust, be it under section 11 or 1023C, with the direction that it will form part of the corpus, then no more you can claim it as utilization. No more you can claim it as utilization. Okay. What is not considered as utilization? Depreciation, where the asset is claimed as utilization. Donation to another charitable trust with the direction that it will form part of corpus. Now both 11 and 23C. 30% of the fund if it is taxes not deducted at source. 40A3 violation. These will not be considered as utilization. Okay. What is deemed utilization, or when can utilization be? There were 3 cases. The law gives us 3 cases. 11.1, impractical. That is, donation is received very late, only in the month of March. Then the trust can apply for deferment. It needs to be utilized in the succeeding year. Where you have accounted on accrual basis, due but not received, only in the year of due or in its subsequent year. Conditional accumulation. That is, you are carrying on some capital activity, you can make an application. Maximum permissible is 5 years. Lesser than that can also be given, but maximum it cannot exceed 5 years. So these are all the three cases. Impracticable to apply, due but not received, conditional accumulation. Then comes the anonymous donation, where the details of the donor is not available. Up to 5%. You can get up to 5% or 1 lakh, whichever is higher, you can get it as anonymous donation. Okay, up to 5% or 1 lakh, whichever is higher, you can get it as anonymous donation, but not a this provision is not for religious trust. Over and above that, it is taxable at 30%. Over and above that, it is taxable at 30%. How to compute? Okay, voluntary contribution other than corpus donation and anonymous donation, income from property, any other income. Total income less 15% set apart. This is the money to be utilized. The utilization for the expenses, utilization due to deferral, and utilization in the nature of donation to another trust. Okay, this is taxable at slab rates.
Sir,
Listen,
sir, that 5 years accumulation, does it start from the year in which we are receiving the fund?
yes, year of application 31/3 and the date line. Or
So,
you can understand it a year of receiving of funds. You are right. You can understand it so.
so if I'm receiving on 30th March and I say I'm accumulating for 5 years, still the 2 days will be considered as 1 year.
No, 5 years from 31st March, from the year end.
Oh,
31st
okay.
March 21 apply பண்ணேன்னா 31st March 26 வரைக்கும் உனக்கு டைம் மேக்ஸிமம். Okay. 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 In this entire thing, I want you to understand that there are a couple of extra case laws. Actually, not extra case laws. In fact, I can say this as yeah. This is a that Meenakshi Ammal endowment. Can application be made within a short span? Yes, it can be made. And the case law போயிட்டு அதுக்கு பதிலா they have added two other citations. Ananda Social and Educational Trust, Foundation of Ophthalmic and Optometry Educational Research. In this, the Ananda Social Research, it's a Supreme Court judgment where application can be made within a short period of time also, because 12AA is an enabling provision held by court that the purpose of section 12AA is to enable grant of registration for trust whose objects are genuine. For trust whose object of genuine. The said section is a granting section and not an assessment section. There are other provisions available where registration can be cancelled if later that it is purported the purpose is not fulfilled. Hence, application on short span will also qualify for grant of registration even if there is no charitable activity. So you can within 2 months, within 1 month, எப்ப வேணா apply பண்ணிடலாம். So remember this case law, Ananda Social and Educational Trust. Okay, that is a new means not for the all people. Those who have learned last year, it would be. Otherwise, Queen's Educational and St. Peter's are same. Profit is not the criteria. Profit is not the criteria, even if it is earned profit but used it for specified purpose enough, and there need not be a government recognized codes, even private certification. Okay, deemed registration, Society for Promotion of Education, within 6 months if you have not done it. UP Distilleries Association, this case law is almost gone because of the faceless assessment type. Okay, where I raided the premises of a secretary of the trust, but he is the main man who is taking decisions of the trust. The entire trust activities were conducted in the Secretary's General premises. Further, the statement provided by the Secretary General pertains to the operation of trust. Hence, cancellation of registration of the trust is possible. Okay. 15% needs to be computed on gross receipts. This Supreme Court itself has said, sometimes some of our books are wrongly working. It needs to be computed on gross working. Okay, this is Govind Bhai. Okay, the purpose of 80G and 11 are different. 80G does not relate to assessment. Non-fulfillment of condition by the trust cannot be ascertained at the time of the donor. So donor should not be penalized. He should be provided the deduction. He should be provided the deduction. Remember, these are all the case laws. More than why I quickly recollected is because trust, whatever 6 out of 6 or 4 out of 4, whatever is the marks, we are trying to get it. Okay. Question number 1. Global Mission Charitable Trust, registered under Section 12AA, had spent 92% of their receipt of the object of the trust and has filed the return within the due date under Section 139. CIT sought to cancel the registration of the trust as there were violations under FCRA, Foreign Contribution Regulation Act, which the trust has accepted to have violated and not preferred an appeal. The trust represents to you that all required formalities under the income tax law are fulfilled and there is no power to cancel registration for violation of any other law. In this context, highlight the provision and provide your opinion. Will your answer be different if the trust has gone on an appeal? Okay, this is a very nice question. Okay, question 1, because it came as an amendment in 2019 Finance Act. Okay, cancellation of registration granted to a trust can be made on the following grounds. Cancellation of registration can be made on the following grounds. If money is not spent for object, if money is spent for personal purpose of trustees or promoters, if the trust is carrying on objects which are not mentioned, and then they added, if the trust has violated any other law and has not preferred an appeal against such violation. In other words, accepted the violation. So this was added actually in Finance Act 2019. This was added as in Finance Act 2019. There was a new section supposed to have been introduced, the section 12AB, that has been deferred by a year. Now that is not introduced. So in 12AA they brought this itself, if the trust has violated under any other law. In the given circumstance, in the given case, the trust has violated the provisions of FCRA and has not preferred an appeal. Okay, even though the conditions specified under section 11 of the IT Act are fulfilled, that is 85% utilization, books maintenance, all these things are fulfilled, still the CIT can cancel registration as trust has violated other law. Okay, so even though the trust is fulfilling other conditions, it cannot, the registration will be cancelled. Okay, part B, however, where the trust has preferred an appeal, then CIT does not have the power to cancel registration because they have to wait for the court judgment. Then the violation will not stand, so you cannot cancel registration. Normally, registration of the trust can only be made by CIT. Is ITAT empowered to grant registration? Is the power unconditional? Okay. Question number 2. Okay. ITAT can pass any judgment as it deems fit. Okay, என்ன judgment வேணா pass பண்ணலாம் as it deems fit. It is inherent power of ITAT. So it is an inherent power of ITAT to grant registration. Okay, so ITAT will have an inherent power to grant registration. Okay, but இப்போ recent ஒரு கேஸ்ல the court has laid some guidelines. The court has not said that you cannot, but you refer it back to the commissioner itself. Why do you want to take it under your control? Okay, why do you want to take it under your control? You refer it back to the commissioner itself. Is the court opinion, okay, in the recent case, Rahman Foundation. Okay, can appellate tribunal, while hearing an appeal under 254 in a matter where registration under 12A has been denied, itself pass an order directing the commissioner? The High Court held that the appellate tribunal, while hearing an appeal in a matter where registration has been denied, but can itself pass an order directing registration only in the case tribunal disagrees with the opinion of the CIT as regards to the genuineness of the object of the trust. Okay, however, the said power is not to be exercised by the ITAT as a matter of course, and remand to the CIT is to be made where the appellate tribunal records a divergent view on the basis of material. So normally the power is available with the ITAT, but wherever there is a dispute, you can remand it back to them. This is generally only the condition. Okay, but generally ITAT have the power. Refer Rahman Foundation. All these assessment cases are going to go off because of faceless. Question number 3. A trust incorporated in April 2020 presented an application in May 2020. Can the application be rejected within what time should the CIT communicate? And if there is no communication, what will be the consequence? There are some properties written in favor of the trust, but due to ongoing pendency, these were unable to be transferred. Okay, I request you to this alone. This case law is gone. Ketri Trust case law is no more part of your case law. The first two are only your part of your case law. Okay, question number 3. Okay, the first one is refer Ananda Social Club and Promotion of Arts. Okay, okay, I'm not exactly writing the name, you know that. Okay, the first one, yes, it can be. Supreme Court has said that 12AA is not a assessment grant of registration. Is the object genuine, then grant the registration. If the objects of the trust are genuine, then grant the registration. Okay, so you cannot deny registration just because it is of shorter notice. There are other mechanisms where later, even after granting the registration, if you find that the objects has not been properly fulfilled, you can cancel the registration. Then within what time should CIT communicate? Within 6 months. If they have not communicated within 6 months, we know a Society for Promotion of Arts that if there is no communication within 6 months, deemed registration can be taken. Society for Promotion of Arts. Okay, those two. Where an institution imparting education incidentally make profit, would it lead to a circumstance that it solely exists? No. Queen's Educational Society. Okay. Question number 4. Refer Queen's Educational Society. No, no, it will not lead to a circumstance where you fail to apply by it. Profit, incidentally, profits can come. That profit should also be utilized for object of that trust, okay, and not otherwise. I will speak about exit tax little later. Okay. About that 115 exit tax, I will speak little later. Question number 6. An institution having advancement of any other object of public utility as its main object is registered under 12AA. Its total receipt for the year is 50 lakhs, out of which trading activity 15. Would the institution continue to retain its charitable status and eligible for exemption under 11 if it applies its receipts from trading object as main object for its main purpose? Would your answer be different if the main object is yoga? Okay. Okay. Where the trust is falling under objects of general public utility, where the trust is falling under objects of general public utility. Gross receipts, okay, is 50 lakhs. Gross receipts 50 lakhs. Okay, trading receipt is 15 lakhs. Okay, percentage of trading receipt, 30%. Since trading receipt exceeds 20% of gross receipts, the trust loses the benefit of claiming exemption, okay, only for the financial year 2021. Okay, it does not permanently lose. It loses it only for the financial year 2021. Okay, would the institution continue to retain its charitable trust? The institution will continue to retain the charitable trust status, okay, and that won't be affected because it's a continuous one, okay, right? Then and eligible for exemption if it applies the receipt for trading, okay. The trust will lose the exemption under section 11 for FY 2021, even if the trading receipts are utilized for the object of the trust. You are not supposed to do business. If you do, you lose the benefit just because you have applied it for the object of the trust. Only education, medical, all those things will enjoy it. Okay? Where the trust falls under yoga. Where the trust, okay? There is no limitation on business income, where the trust has utilized at least 85% of its receipt for the objects, exemption can be claimed. So even if it is 30%, 40%, there is no limitation. The only question we have is, have you utilized 85% of your gross resource for the purpose of the benefit of the trust? If that is fulfilled, then no problem. You can continue to enjoy the exemption. You can continue to enjoy the exemption. Question number 7. Kamala Charitable Trust, having its object as main object as medical relief, earn the following income. Okay, earn the following income. I want to tell you that this question is a slightly old question. Okay, having its main object as medical relief, earn the following income: dividend income, income from mutual fund, agricultural income. The trust claims exemption under 1031, 1034, 1035 are not there for this year. Okay, but I want you to understand the question in respect of its agricultural, dividend and income from mutual funds without complying with the conditions laid down. So, okay, don't look at the nature of income. I'll go to the broader picture. I have received an income which is exempt in my hands. Okay, I have received, I here is trust. Trust has received an income which is exempt in their hands. Trust has received an income which is exempt in their hands. Can they claim? Can they claim the entire amount as exempt even if they have not utilized it for the said purpose? Previously also not. Now you have an amendment also which clearly says that, okay, where trust or institution has been granted registration for the purpose of availing exemption under section 11 and the registration is in force for the previous year, then such trust or institution cannot claim any exemption under any provisions of section 10 other than 1021, 1023 C and 1046. 1046 is government institutions, 1023 is small educational institution hospitals, 101 is agricultural income. You can claim for agricultural income. All other incomes, even though they are exempt, you cannot claim the exemption. You should have utilized the 85% of it to claim exemption. This question came when it was dividend income and mutual fund income were exempt. So I am writing the broader answer for this, not exactly for this question, but the broader answer. Question number 7. The broad question is, can a trust claim exemption under section 10 even if they have not utilized the income for the object of the trust? The answer is no. Trust is not eligible to claim section 10 exemption they are liable to utilize at least 85% and claim exemption only under section 11. Okay, no you are. Okay, exception. However, agricultural income, even if not utilized, is exempt. However, agricultural income, even if it is not utilized, that alone I accept, you can claim the exemption. But otherwise, the trust cannot claim any exemption under section 11. The trust cannot claim any exemption under under section 10. Okay, agriculture. 1023C, 1046 are part of trust, so I'm not writing that. Agricultural income, you can still claim, but other exemptions of section 10, which the trust gets, if trust is a partner of a firm, gets share of profit, you cannot claim 10.2. You cannot claim 10.2. On the share of profit, you should have applied 85%. Trust cannot be partner is different, but I'm just telling you, for example, that it is the broader guideline. So I'm not answering this particular question because it has lost its relevance now, but generally. Question number,
Sir,
yeah, yes, friend.
sir, section 11 and 1023C are mutually exclusive now, sir.
Yeah,
How
yeah,
can we claim
mutually
it?
exclusive.
No, because in that theory we had written other than 10.1, 1023C, that's why I have
But in the amendment, okay,
yes, sir.
yeah, I understand that. Okay, that is just to understand that 1023C and 1046 are part and parcel of the. They are mutually exclusive. Once you are claiming 11, you cannot claim 1023C. That is for sure. But just to make you understand that these three are the exclusion section, all others are inclusion.
Sir, could you also tell what is 1046 exactly, sir?
1046 is government institutions. Now AICTE, All India Council for Technical Education, is the recognized one. Though the income might be higher, they are all falling under, all central and state government institutions are coming under 1046.
For them, their 100% income is
Yes,
exempt.
exempt. Yeah. A charitable trust gives you the following particulars: compute income and its tax, income from property held under trust, voluntary contribution including 10 lakhs of anonymous donation, expenses, conditional accumulation, income accrued but not yet received, purchase of asset, donation to another institution with the condition that it will form part of the corpus of the trust, brought forward losses. One lakh of 146.32. 1 lakh 46, 1 crore 46 lakh 32,000. 1 crore 46 lakh 32,000. Voluntary contribution other than anonymous donation. Thirty-two lakhs minus 10 lakhs. 32 lakhs minus 10 lakhs. Okay, this is the total income. Yes, this is the total receipt. Yes, 15% set apart. Amount to be utilized. Amount to be utilized. This is the key point. Amount to be utilized. Amount actually utilized. Okay, amount actually utilized. Okay, expenses 81,40,000. Expenses 81,40,000. Okay, uh, conditional accumulation 10 lakhs. Conditional 10 lakhs. Conditional income accrued but not received 5 lakhs. Accrued but not received 5 lakhs. Okay. Purchase of asset 4,50,000. Purchase of asset. However, depreciation cannot be claimed in future years. 4,50,000. Donation to another trust with the condition that it will form part of corpus. Donation to another trust will not qualify as it is mentioned as forming part of corpus of the other trust. So it will not qualify. Yes, brought forward loss. Brought forward loss is 3 lakhs. Brought forward loss is 3 lakhs. Taxable income, the trust. 39, 17, 200. 39, 17, 200. Okay, 39, 17, 200. Okay, now computation of tax. Computation of tax. Total voluntary contribution. Total voluntary contribution, I think 32 lakhs. 32 lakhs. Anonymous donation of that is 10 lakhs. Of that, anonymous donation is 5 lakhs. Anonymous donation taxable at normal rates 5% of gross voluntary contribution, 5% of gross voluntary contribution, okay, limit 1 lakh, whichever is higher. So this amongst these two, whichever is higher is taxable at normal rate. Anonymous donation taxable at 30% under section 115 BBC is 10 lakhs minus 1 lakh 60,000, 8 lakh 40,000. Repeating, 5% of 5% of total donation or 1 lakh, whichever is higher, is acceptable. So that is taxable at normal rates. Balance of anonymous donation is taxable at 30%. Balance of anonymous donation is taxable at 30%. Now there are two options. We don't have but for examination safety, option Option 1, income taxable at slab rates, okay, is, okay, 39,17,200 plus 1,60,000. So how much it comes to this? Minus 10 lakhs into 30% plus 1,12,500. Okay, anonymous donation, okay, taxable at 30% is 8,40,000. This into 30% and HEC at 4%. Okay, HEC at 4%. Okay. Total tax under option 1, where whole of the anonymous donation taxable at normal rates are considered. Okay. Option 2, where only 85% of anonymous donation taxable at normal rates should be considered. Okay. Okay. Income taxable at normal rates will be, my dear, 39,17,200 plus 1,60,000 into 85% into 85%. This will be 8,40,000. In exam, please write both. In exam, please write both.
Sir,
Raja?
sir, in the exam, if the question stops with compute total income of the trust,
No
should we
problem.
add one?
You can try. You can stop here. You can stop with this, and but anonymous donation in the tax இல்லாம இருக்காது. Sure shot.
And that 85% should be added like option 2 or the income.
Yeah, you can add it and show. You should show these two answers: 40 77 200 and 840, 40 53 200 and 840. But anonymous donation இருந்தா கண்டிப்பா tax இருக்கிறது. பர்பஸே அதான். But if they stop at it, you can take this.
Right.
Edu all registered under 12AA following cash system of accounting. Okay, furnishes you the following: gross receipts from hospital 200 lakhs, gross receipt from medical college 95 lakhs. So this is fully exempt under 1023C. Educational institution, medical institution, government aided, where 51% or more of the income is from the government. So these three will fall under 1023C, where their income is fully exempt. Corpus donation by way of check and by way of cash, no problem. I have never said that that is anonymous donation. Anonymous donation means donor detail not available. Anonymous donation by cash. This is only is a 115 BBC. Administrative expenses of hospital 75 lakh. Out of this, 5 lakhs was paid without deducting tax at source. Another 1 lakh on a single day to a person. Fees not realized from patients. This will not at all be forming part of this income because they are accounting it on cash basis. Don't consider it as amount due but not received because they don't account it at all. Okay, so this will not be treated as income. Depreciation on assets of the trust. The entire cost of the asset was claimed earlier as in the earlier year. Acquired a building for 80 lakhs for expansion of hospital. Cost of land therein 50 lakhs. Stamp duty of land and building on the date of registration is 210 lakhs. The trust gave corpus donation of 19 lakhs to another trust having objects of similar nature but not similar to the object of the donor. No problem. You are required to compute the total income of the trust and its income tax liability and it is tax liability in such a manner that it can avail the maximum. Will your answer change if the corpus donation is given to a trust under 1023C? My answer will not change. Oh, the trust gave corpus donation. Okay. Sorry, it cannot be claimed. If will your answer change? No, it will not change because till last year only this 1023C trust means I can allow it. Now it is not allowed. Now it is not allowed. Work along, please. Work along.
Sir, is 1023C also registration to be done, or is it just an
No,
exemption,
no,
sir?
no. It's a registration has to be done. Registration formalities are the same.
So corpus donation given to 12AA or 1023C both are considered in this.
Yes.
Yes.
As the gross receipt has not exceeded 1 crore, it is fully exempt. It is fully exempt. It is fully exempt. Okay. Corpus donation by way of check 42 lakhs and by way of cash 6 lakhs. Anonymous donation, let us consider it separately. Anonymous donation, so let us consider it separately. Here I am writing it for your purpose. Okay. Cash donation does not have any specific provision. For the donor, they cannot claim exemption, that is different, but we don't have any specific provision. Okay. Administrative expenses 75 lakhs, out of which 5 lakhs was paid without deducting tax at source. So 70% of 5 lakhs will only be allowed and that 1 lakh will not be allowed because it is paid in cash. Administrative expenses. Okay. Remember 75 lakhs minus 1 lakh paid in cash minus 5 lakh into 30%. Okay, 72 lakh 50,000 will only be allowed cash donation. In exam, please write the note here. I know you are understanding, so I am not writing the note. In exam, please write that 70% of this will only be allowed and this 1 lakh paid on a single day will not be allowed. I am writing this note also. Fees due but not received will not be adjusted as the entity is following cash basis of accounting. Hence, the 200 lakhs of receipt will not include this fee. So, I am not making any adjustment because this 2 crores will not include this because we are following cash basis of accounting. Depreciation 3750, the entire cost was previously claimed. Okay, depreciation will not be allowed as the cost of asset was claimed as deduction. Acquired 80 lakhs for expansion of hospital building. Okay, expansion of hospital building 80 lakhs. 80 lakhs. I will write the note for inadequate compensation later. Okay. The trust gave corpus donation. Corpus donation provided will not qualify for deduction. So, some utilized will be okay. Of the trust. 17 lakh 50,000. Income of the trust 17 lakh 50,000. Note. Provisions of section 56, 5627 if you want, but okay, inadequate consideration, okay, are not applicable for public charitable trust. So you need not take the inadequate consideration. Yeah, okay. We all know, even if they donate also, it is not going to be considered. That will not be considered as gift. So this you need not. So income of the trust 17 lakh 50,000. Okay. Okay. Now computation of tax. Total voluntary contribution. Total voluntary contribution, you can see in the question, total voluntary contribution is 42 plus 6 plus 12, 42 lakhs, okay, 42 lakhs plus 6 lakhs plus 12 lakhs. 42 plus 6 plus 12. 60 lakhs is the total voluntary contribution. Anonymous donation. Anonymous donation of that comes to 12 lakhs. Okay, 12 lakhs. Okay, AD as a percentage of total donation. AD, sorry, no. Okay, anonymous donation 12 lakhs. AD taxable at normal rates. AD taxable at normal rates. 5% of total donation. 5% of total donation. Okay, maximum 1 lakh. So whichever is higher. Okay, maximum of these two things, whichever is higher. 3 lakhs. is the AD taxable at normal rates. Okay, now option 1, where entire amount of AD taxable at normal rates are considered. Okay, income taxable at normal rates is 17,50,000 plus 3 lakhs. Income taxable at 30% is 12 lakh minus 3 lakhs. 12 lakh minus 3 lakhs. For this, option 2, where only 85% of AD taxable at normal rates are considered. One minute, friends. 1 minute.
Yes.
Yes, I'm listening.
Sir, I have a doubt, sir. Sir, in some ICA suggested answers, they are sometimes taking this application as reduction from receipts, sir. I don't understand. There is no.
No, 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 no. That has been, that's why I gave you the Supreme Court judgment itself. 15% of gross receipt should only be taken. There is a Supreme Court judgment itself. But none of their suggested answers have that. I know what you are talking in the material, they have it. Please leave it. This is the correct way of working. Please leave it. There is a judgment which
So one more doubt is,
uh,
so one is for this accumulation, they invest in certain 11.5 modes,
yeah,
certain investment modes,
yeah.
which they should we remember all modes
No,
or
no, 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 no,
any
no, no,
way
no,
to
sir.
remember
No,
those,
no.
sir?
They have not questioned. They have not questioned that. They have not questioned that. Don't worry, sir. Okay, right. Now I'm going for this aspect which I said I'll come back to it, which is popularly known as exit tax, which is popularly known as exit tax, my dear friends. Okay, okay. This is popularly known as exit tax. 115 PD of the law specifies this, where it loses registration, where they lose registration, where they dissolved and they have not distributed within 1 year to another trust, or where they merge with an unregistered trust or with any other non-trust. Exit tax will be paid on the net asset value. Please understand it as net asset value. Okay, exit tax will be paid on the net asset value. How to arrive at the net asset value? Asset acquired out of agree income you will not take, because agree is always exempt. Asset acquired before grant of registration also you would have taxed it, you would not take. Other assets, if it is immovable asset, FMV or stamp value, whichever is higher. Other tangible assets, FMV. Investments, high quoted, whatever is the highest quote on the specified date. Other investments will be based upon the net worth of the company. If it is unlisted, net in okay, less liabilities pertaining to the above said asset. Liabilities pertaining to the above said asset, okay, income tax will not be allowed. Only liabilities pertaining to the above said asset. Suppose if there is a liability for land acquired out of agricultural income, you will not take it, because that you will not take it. Okay, land or building, stamp value or FMB, whichever is other. Other things FMB, shares take the highest value. Unlisted shares, if they have given, take the normal way. Okay, it will be taxable at 34.944 or 42, because 30% plus 12% plus 4%. MMR கொடுத்துட்டு 34.944 even in the recent RTP. That's why I just want to check it before telling you, because I checked it some 15-20 days back. Even in the recent RTP, they have done 34.944, but they have used the word MM. In all other places, that is REIT and all, if it is MMR 42.744. But here alone, they are using the word MMR, but they are taxing it at 34.944 percentage. Please follow that, because no option available to us. In all RTPs, etc., they are taxing it so. Question number 10.
Sir, maybe because it is changed into company, they are using company's highest slab rate.
REITM company தானடா.
All right, right.
Supporting the girl child. A charitable trust is registered under 12AA. On 1/4, it got merged with a company, which is a company engaged in manufacturing. all the assets and the liabilities of the erstwhile trust became the assets and liabilities of the company who is not entitled for registration under 12AA. The trust appointed a registered valuer for valuation of assets and liabilities from the particulars. Calculate the tax liability in the trans of the trust on the date of merger. Stamp duty value of land held 15 lakhs. However, if the land is sold in the fair market value, it is 17 lakhs. The book value of the land is 20 lakhs. 75,000 shares of a company, listed company, the lowest price being 75 and the highest price being 85. The book value was 67. 55,000 preference shares. The shares will fetch 44 lakhs if they are sold in the open market. Book value being 25. Corpus fund, outside liability, provision for taxation, liability in respect of various bills. Okay, utility bills. Actually, இதே question தான் இப்பயும் கொடுத்திருக்காங்க with little more detail in the RTP லையும். Okay, first we will complete this question number 10. Question number 10. Since the trust got merged with the company which cannot be registered under 12AA, the trust is liable to pay exit tax. The trust is exiting out of trust, being a trust, so it has to pay exit tax. Exit tax under section 115TD is computed on accredited income, which is asset minus liabilities. Assets minus liabilities. Exit tax is at MMR. So for your safety purposes, 34.944 percentage. 34.944 percentage. Okay, exit tax is at MMR. Now, computation of accredited income. Assets. Land and land. Okay. Stamp value or FMV, whichever is higher. Stamp value or FMV, whichever is higher. So, stamp value 15 lakhs, FMV 17 lakhs. Stamp value 15 lakhs, FMV 17 lakhs. Okay. Shares or, okay, listed shares. Okay, what is the number of shares I'm having? I'm having 75,000 equity shares and the highest rate, okay, the lowest price, the highest being rupees 85. 75,000 into 85. 75,000 into 85. Okay, then 55,000 preference shares held. That's FMV of preference shares 44 lakhs. FMV of preference shares 44 lakhs. Okay, 44 lakhs. Okay. Okay. Gross assets. Gross assets. Okay. Yes. Corpus fund, Norton external liability. Corpus fund is like capital, not an external liability. Outside liabilities 90 lakhs. Provision for taxation, not a liability. Liability in respect of bills 6 lakhs. Credited income. You can call it as net assets also. Exit tax at MMR. Ten lakh 4,640. Exit tax at MMR 10 lakh 4,640. This is also a similar question. Okay. EduAid is a charitable trust set up on 1/4/2011 with an object of providing relief to the poor. Later in April 2013, it changed the object to providing education to the underprivileged. It appealed for registration for the first time on the basis of its new education, a new object, and on 12/8/2013 was granted okay, applied on 12/8/2013 and got it from 15/3/2014. So from 13/14, from the financial year 13/14, they have the registration. On 1/4/2020, it got merged with a company not entitled for registration. All the assets and liabilities of the erstwhile trust became the assets and liabilities of the company. The trust appointed registered valuer and the valuation report. Okay, land in Surat, which is purchased before getting the registration. You need not see the values. It is not at all an asset. Agricultural assets, assets acquired out of agricultural income, and asset before grant of registration. They gave you the registration as 13/14. That's why. Okay, land in Baroda 1 crore 5 lakhs for open market value. Okay, 3,000 quoted shares in a company, the highest price being 280. The highest price being 280. Okay, 1,800 preference shares, 210 is the market rate. 210 is the market rate. Purpose one will not qualify. Provision for taxation will not qualify. Okay, sorry, book value of liabilities is 112. This includes these three will not qualify. The other liabilities can be reduced. The other liabilities can be reduced. Okay, this question I leave it to you for completing. This question I leave it to you for completing. It's a replica of the same question. Okay, so that tomorrow morning fresh we can start with capital gains. Tomorrow the key date where we are going to complete capital gain pass-through entities. Though I have done REIT while doing the amendment, just a quick browse through, and then assessment of companies. With tomorrow, we will keep a dot for PGBP chapter with an enormous confidence, so that later I want to cover TDS, TCS on a quick basis, because there is a possibility amendment related question that TDS, TCS. I'm very sure if you read do the amendment lecture enough, but let's do some questions on TDS, TCS, assessment of individuals. Okay, if time permits, surely I will do the assessment procedure once before going in for the last 2 days of international taxation. We'll keep planning as we go by. I'm meeting you at 6 o'clock tomorrow morning to continue our discussion, and we'll start with capital gains. All the best, friends.